Shares of ICICI Lombard trade higher after a steady set of earnings. The net premium earned rises 12%. Profit also sees an uptick. Management says they will try to outperform the market by 100 to 200 basis points on the growth front going forward.
Shares of Persistent System gain over 7% after reporting a strong September quarter. The company's revenue and margin beat estimates, with brokerages CLSA and JP Morgan raising the target price.
Thyrocare rises after reporting a 79% uptick in profit, aided by higher test volumes and improved efficiency, which led to higher margins.
And Godrej Properties gains in trade after acquiring 26-acre land parcel in South Bengaluru, with estimates revenue potential of around 1,100 crore rupees. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as you can see in a short while at the top of the screen, there's green on the screen. So pretty good, Mangalam. Some positive earnings reactions. We've had a bit of a, some consolidation for the last 2-3 trading session. But it appears the bulls are back. We're getting closer to around that 25,330, which will be the first level of resistance.
Bulls are back, and the broader market is doing a lot better as well. Two stocks advancing for every stock which is declining, which is a good, relief from what we saw in the last couple of trading sessions as well. But more importantly, HDFC Bank, that's come back in style. Reports its numbers over the weekend. So let's pull up the intraday chart of HDFC Bank. That's powering the Nifty bank ahead. And alongside that, we have the Nifty as well, which has moved to the high point of trade. For the last couple of sessions, while the other banking stocks were doing well, HDFC Bank was a bit of an underperformer out there, which is why the Nifty bank did not do as well. For the last few minutes, if you look at the intraday chart of HDFC Bank, the Nifty bank and the Nifty, all of them would be fairly congruent in the shape of, the move that we've seen in the last 15 minutes or so. Good time to then welcome Shivangi Sada of Motilal Oswal Financial Services for a quick technical check on the market. Shivangi, the morning so far looks fairly good. We're closer to that 25,300 mark. Do you think today is the day where we break out and actually stay above those levels? Or maybe once again, around 25,330, 25,350, we'll see sell-off?
Very good morning, Mangalam and Nigel. Thank you for having me. So we've seen that festivity cheers are already, showing on the charts for Nifty. Of course, yesterday was, kind of a profit booking day. But the good part is that we saw excellent support-based buying at the 25,050 zone, where there was strengthening of the put writers as well. Even though the fall yesterday, we did not see the put writers shift their strikes. So that was a positive there. Of course, we are going with buy on decline, which is to continue ahead of the festivity and in the series as well. So we're looking at 25,050 as an important support level for the next upside move towards 25,450 marks. This is for the index. Of course, India VIX had given trouble in the last couple of sessions, but the kind of put call ratio that has maintained at its level is positive. Talking about Bank Nifty, of course, we've seen outperformance here. And this has been led by the PSU banks of lately. And we've seen that even, despite the profit booking yesterday, it has managed to surpass above 56,500 levels and hold quite comfortably. So we are looking at 56,500 as a base here, as a support, which was earlier a resistance. So, of course, role reversal has happened here. With that, we're looking at the upside potential for 57,250 marks for Bank Nifty.
Okay, got it, Shivangi. What about individual stocks? What's on your radar?
So having said about the strength in Bank Nifty, my first pick would be from the related space. But of course, this is a digital space platform that I'm talking about. This is Paytm. This stock has kind of come out of its consolidation on the daily basis, and we've seen on the weekly basis as well. It's been, respecting its upward sloping channel. Quite so that we've seen that it has respected its 50 DEMA perfectly as a crucial support level from the last few months. So this one's on radar and getting ready for a potential target of 1320 levels and 1240 as a support for this one. And the second pick on my radar would be Persistent System, where we've seen bottoming out structure here. IT space has kind of shown some sort of strength and a comeback move in the last couple of weeks. And Persistent System has been one of the strongest out of the entire lot. And we've seen that call writers have unwinded their positions here, which is a positive for this one. Even on the weekly basis, it's kind of surpassed and is holding at the higher levels. So this one's quite positive and looking for a good upside. So recommending a buy here with a target of 59.50
Right.
levels with a support of 5,600 levels.
All right, take that point, Shivangi. Thank you so much for joining in, and festive greetings once again. Just before we move forward, keep an eye out on two stocks. We've been so far talking about stocks which have been doing well. Dreamfolks is one that comes up for you. For the last few trading sessions, it's a big up move. In fact, purchase backed by volumes, etc. as well. But today that's come undone. It's down about 7%. So that's the one which is trading on the downside. The other one that I'm looking at is Hotel Leela Palaces. Yesterday, post numbers, the stock was down about 5.5%. Today as well, the management sounded fairly optimistic about growth, mid-teen sort of revenue growth with 2,000 crore EBITDA target by FY30. That's what they've reiterated. But the stock's fallen, and the current level of the stock extremely crucial because the IPO came in at 435 rupees. So with today's decline, it's fallen just marginally before the IPO issue price of 435. So we'll keep an eye out on Leela Palace Hotels. But with that, let's get you some ideas for profit. Our colleagues from Money Control joining in. Today we have Khushbu Rai Gupta of moneycontrol.com.
In today's idea for profit, we have Aditya Birla Capital. The stock has delivered strong returns and outperformed the market following the merger of Aditya Birla Finance Limited, the NBFC arm, with the parent company in March 2025. The robust growth in the asset base and earnings in the June quarter extended the positive market sentiment. The reverse merger has transformed ABCL from a holding company to a large unified operating NBFC with better access to capital and improved operational synergies. The merger will also act as a performance booster on account of more cross-selling opportunities. We feel that the merger synergies, better growth prospects, and improved financial performance are expected to drive the stock performance. While the amalgamation has enhanced the stock valuation due to the elimination of the holding company discount, we feel that any future valuation re-rating will be dependent on the sustained risk-adjusted growth by the company.
All right, with that, we'll slip into a short break. Come back on the other side, a conversation with the management of Lemon Tree Hotels. Stay tuned. Look at the surge that we're seeing in urban company. It's up around 8% right now. Typically, again, a strong seasonal quarter for them. So that stock doing well right now. From its IPO, it's done extremely well too. But let's talk about the hospitality space once again. Patanjali Keswani, who's the chairman and managing director at Lemon Tree Hotels, joins in to discuss the impact of GST cuts. More importantly, the outlook for the second half of this fiscal year. Thanks a lot, Mr. Keswani, for joining in. The obvious question, how's the business been post GST cuts, and has the lack of input tax credit impacted performance for you?
Well, I think, look, there will be obviously an uplift in demand because the price comes down. But on the other hand, there will be a loss of input credit. So one can only hope that the uplift, the flow through from revenue uplift, more than cancels the loss of input credit. And I think input credit should have been retained in an industry like ours, but unfortunately it was not.
Got that, Mr. Keswani. But what kind of quantifiable impact would you have, due to the lack of input tax credit?
We own a lot of our hotels, number one. Okay, and input credit matters either way for us. The reference you are making is for management fee income, but the reference I am making is for ownership. So when I look at our business, about over 50% last year was above 7,500 rupees as an average rate, and about 50% or a little less was under 7,500. Obviously, there is a change in pricing this year, as it happens annually. So I would reckon about 40% of the business that we get is going to be impacted by loss of input credit. Okay. If I quantified it on a revenue basis, I would estimate it would be in the range of about 1.5 to 2% of revenue. Say 2% of revenue. So that's the impact on margins. But will your revenue go up by more than 2% because of this fairly significant drop in GST? Well, I would hope so. And if that happens, then this becomes, one cancels the other.
All right, so about 100 to 200 basis points impact on the margins, but if that's offset by higher revenue because of lower prices, that would be a positive for you. But the second half, it's a strong season for the hospitality industry. How's that looking for you?
Q2, you had a good last year, and therefore Q2 this year, in relative performance to Q2 last year, would not have been anywhere near as good as Q1 was to last year Q1. Now, when I look forward into Q3, the interesting thing is what affected Q2 will not affect Q3 this year. For example, there were a lot of festivals and so on last year in Q3, which occurred this year in Q2, which deflated demand this year in Q2. I hope I'm making sense to you. And so when I look at Q3 this year, Diwali, Dasera, all of it put together has occurred and will occur in October. Okay, so that gives you what's called a clear November this year, whereas last year Diwali was towards the end of October and the impact was felt through in November. Keep in mind that in our industry, I would say the 3 most critical months, 3 to 4 most critical months are after Diwali till middle of December, and after January 26th till middle of March. These 3.5, 4 months account for 50% of your revenue. Because it goes gangbusters then, demand from every possible segment. So this year we are going to have a very, very good H2 compared to last year, primarily driven by the fact that you have this enormous upswing in November this year, which you did not have last year.
That's a little tricky answer there, Mr. Keswani. Let's keep things simple though. How much higher will growth be in the second half of the year compared to last year?
We had a very, very good Q1, for example, the industry. By the way, I'm talking industry. And I think 18 to 20% was the growth. So I would not be very surprised if we did not at least do mid-teens growth this H2, tending towards late teens versus last year.
All right. And what are the new properties that you're opening? All right. Just before we let you go, what's the update on the restructuring, sir?
You'll have to wait for 2 months. That's being discussed, but there is plenty of very interesting stuff happening in our company, and that should be out by the end of this calendar year.
Wait, you said you have to wait for 2 more months. Could you give us some more details of the interesting stuff?
We are looking at multiple things, one of which is, of course, the listing of Fleur and a pre-IPO kind of valuation. So we will look at raising some money in Fleur. We will also look at the route to listing Fleur, which is it a direct list or a demerger? Third is, we will be looking at certain large acquisitions for our company. And parts of it you've already seen. We've acquired, the 550 room Aurika plot in Delhi, which is very, very important for us. And there are many, many more things happening. Can't tell you right now, but for me, it's going to be a super busy Q3 because of so much happening there.
Okay, all right, Mr. Keswani. Appreciate you joining in. Always a pleasure talking to you. Look forward to catching up with you rather soon. Well, it's time to slip into a short break, but as we do that, a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the line graph. This is a score assigned to each stock based on Moneycontrol's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameters considered for calculation of the 4 factors are score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor, viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions. Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. By the way, that's a big order coming in for a smaller company, PowerMech. Remember, the stock has been under pressure in the last few months because there was a lack of any order win. Now the company has gone ahead. They have secured a large-scale order of around 2,500 crore rupees from BHEL. This is for an EPC package for the balance of plants at Singareni Super Thermal Power Project. So this will be read positively because the management had guided for around 10,000 crores of order inflow. And that was lacking till the half-year mark. But now this 2,500 crores seems to be, the trigger that the street was looking forward to. A rank underperformer in the last 1 year or so. Last 4 months as well, the stock was under pressure because the street was expecting this order and it didn't come about. They've given further details that 38 months from the start of work is when they'll have to execute it. So we'll have to keep an eye out on what kind of margins, what kind of profitability they'll be making as well. But that large order that the street was anticipating for the last quarter or so has finally come in for this smaller name. Moving to Persistent Systems, though, that's the stock that's in focus today. It's up close to 6%. They reported solid set of numbers. Rima told us earlier today she's joining in to help us out with the revision of that and what brokerages are making of it. Rima?
So, JM Financial calls Persistent's quarter a near-perfect quarter. Nomura says it's an all-round performance in Q2, while CLSA has a high conviction outperform rating on Persistent. Now, the company's done well. It's beaten expectations on revenues and margins. Revenue growth is 4.4%. And if you look at the dollar revenue growth, it's been above 3% for 22 straight quarters. That's phenomenal consistency. Margins, too, have expanded by 80 basis points to 16.3%. The company is guiding for 100 basis points margin expansion this year, FY26, despite the wage hike which kicks in 1st October, and another 100 basis points expansion in FY27. Brokerage view is positive to neutral. So the bullish calls are from JM, CLSA, Nomura, HSBC have a hold neutral call, and Ambit has a sell call on the stock. Now, the reason why Ambit has a sell call is because valuations are on the higher side for Persistent, and according to their calculations, close to about 42 times forward multiple. But CLSA likes the story because this is a company, according to the calculation, growing 29% EPS over FY25 to FY27, and JM Financial likes the consistency.
All right, Rima, thanks a lot for that. With that, we are wrapping up on this edition of Chartbusters, but you stay tuned because an exciting conversation with Motilal Oswal's Ramdev Agarwal coming up next.